Welcome, everyone. I'm Greg Schnell, the Canadian technician, here to host the Market Buzz. This show looks at weekly setups across the U.S. market. Using the tools available on StockCharts, we'll look for long time frame trades. Please subscribe to my articles and Twitter feed. And don't we have ourselves a kitchen cooking today? We got lots of stuff going on. A little bit of a boom bust thing going on in the bond scenario. Disney down 6% or something today, but the beast is going to be having ESPN, Hulu, and all of the Disney content for $12 a month. I think that puts pressure on a few other charts. Bond yields plummet, and so now we're testing the 2012 lows, 2016 lows. So we're all looking to see if there's a floor down here. Typically, bond yields don't bottom the week after the Fed starts cutting interest rates. So let's not expect that this is the immediate long-term low here. I think we're looking for a much bigger gap on this bond yields, and we'll try to figure it out from there. We're going to go through the bond charts quite detailed. Commodity crush, obviously oil falling, copper breaking the 17-year trend line. It's a mess out there across the commodity space, but gold is soaring, and it's a little bit of as more debt becomes negative yielding and priced in US dollars, gold seems to be rising. So lots going on out there. I think we got enough to keep us busy for a couple of days, not a half hour, but let's get into it. Okay, so let's just go through my bond charts. And again, once a month, I go through all of my bonds, and what we typically see on these charts is, let's just see if I can go one bigger. Is that too much? Yeah, that's just a little too much. Okay. What we typically see on the bond market, it's not supposed to move so rapidly or so violently. And with the Fed interest rate change, it's clearly moving violently. And one of the things that we're watching, so this is LIBOR, and as you can see, LIBOR, it's down here below this 2.22. So it's falling rapidly here. And, last time we saw this obviously was the 08-09 crisis period. So this is moving down pretty hard. We saw a little bit of one here in 2011 into 2012. And this is when the Fed kicked in quantitative easing and basically just trapped interest rates low. So high yield, I think this says it all right in the middle. If risk is rising, so is this, and actually we're having downside risk. So this is pointed south, going down. And so when people want to buy risky assets, this chart goes up. Now, obviously, the real problem is we kind of made this double top right here. We've had this horizontal line running across the chart for years. Again, this is unadjusted, and what that means is we've taken out the yield payment that you would get from owning these corporate bonds, and so it tries to keep just the price and not the yield. Now, obviously, this uptrend is broken. We're still above the 40-week moving average, so things, some people would say aren't very bearish, but I would suggest that we've got a lower high in this momentum here off the April high, and after bouncing out of this low pit, looks to me like we're rolling over. So getting into the treasuries, you can see they're absolutely soaring to the upside. So this is the bond price, and this is heading higher here. And now we're going to go test that 2016 high on this chart at $113.80. So, continuing to soar up. And one of the things you'll see, notice over here that as these soar, even during the pullback here, it wasn't the market really didn't start dropping until this got back to negative. So it's pretty important to be aware that there's still lots of upside left on this chart. Might be a shaky upside, but lots of upside left. Now, this chart compares the difference between the 7 to 10-year bond yields and the high yield that I showed you first. And this low in here is sitting in the background, and we've obviously taken that out. So we're down to new 3-year lows on this spread. And what we're trying to find, obviously, when we're looking at spreads like this, is when will the market bottom? And what you see here in 2014-15, commodities started to break down, and then they really fell. And this high yield was kind of reflecting some of the debt in energy markets. A lot of the energy stocks were considered high yield. And so they've been plummeting quite hard now. So this also puts pressure on the high yield market. But when the stock market and the commodities bottomed in 2016, everything reverted back up. And so far, I don't think this looks like a bottom here. This looks, like we're just getting started. So I'm expecting more of this sort of a big push down. And when we get that big push down, that's probably when we're there. So I'm expecting more selling to go on in the high yield space. The This investment grade corporate bond, you can see breaking out to new highs here, and we stalled as we tried to get through this horizontal resistance layer. Now we've clearly popped up. The previous high was 124. We're at 126. So this is taking off to the upside, and I think it's just important to be aware of one long-term trend. Right here's the 2009 to 2019 trend line. Yes, we could set it right on here, but I think we get a lot more touches if we do it this way. And so I'd suggest that this is kind of the real support and resistance layer on here, and we still have some room to go. Let's call it 2800 before we start touching that trend line. I'm pretty sure we're going to find some support at that level, at least for an interim bounce. So our tips chart, inflation protected bonds are soaring, and gold is also soaring. That's the gold line. And then copper's doing exactly the opposite. Copper's falling hard. And one of the problems with copper falling hard is that's a global economic demand indicator, not a stock market indicator, but an economic demand indicator of raw materials. So the TLT, this thing, went sideways for almost 6 weeks here. And now, as you can see, this is quite a ballistic move. Now, if we look over, back in the 2016 period here, so the stock market bottomed in February and this bond market kind of topped out 6 months later. So there's a lot of people who were very, very bullish and expect that, as soon as these bond yields start to reverse, that'll change everything. But again, bond yields don't usually reverse right after a Fed started to drop interest rates. So we're expecting bond prices higher, bond yields lower for a while. This is my Blackrock Municipal Bond Fund. And I use this to try and give me ideas about which way the 10-year wants to lean, and the idea being, this is pretty safe asset base, and watching what people do here. So in early 2019, this broke out above the momentum trend it had built. And now it's been relatively flat in momentum, but at a high level. So this thing just keeps climbing here. And so far, it could climb for a while yet. Don't see any real reason for it not to. But there's also been money coming into this recently. And it's that kind of change where we're seeing money allocations go. So while everybody else is still trying to be bullish the stock market, I think this is kind of telling us a different story. Now, this is a monthly bond chart. This is the move in the first 5 trading days of the month. Kind of extreme. And we're getting to this momentum trend line. It clearly looks like we're going to smash through that. And so going through all of these trend lines tells me that the bottom is nowhere in place yet. And this 2012 low and 2016 lows were a few basis points off that, but I'm expecting that we're going to probably get down there quite quickly. Okay, zooming in on the bond 10-year, what we see here is this chart is obviously falling here, and now we're into the waterfall phase. Usually, when you get this waterfall effect where things are just kind of plummeting, eventually it kind of thuds, and we'll get something like, over in here, maybe some 3-week chop or something where it tries to build a bit of a base and go out of here. Even this one in here in 2016, the sudden surge down, and then it rallied for 3 or 4 weeks and then fell apart again. We still have lots of I'll call it underlying reasons for the bond market to continue to get worse. Whether it does that in a straight line or not, I don't expect that. I mean, this has been a dramatic move from 2.1 to 1.6. So what are we, a half a percentage point or a 25% drop in 2 weeks? So it's a little bit of a stretch. And so I wouldn't be betting on this thing continuing every day, but I have lots of charts that says this thing can move huge for the next long while. This is the 5-year chart, and as you can see, clearly falling out of bed here. It's been below zero on the PPO for 7 months, at least maybe 9 months since the October drop back in here. And as you can see, we just seem to be continuing that period, and that was really when everything started to fall apart. So above then, it stayed mostly above zero. Now it's staying mostly below zero. That's a trend change. And look at the RSI, and we can see it stays below 60. And in bull market mode here, it barely dipped below this 40 level for 2 or 3 years. Now we've changed that trend. US 2-year, this is 2006, 2007, and you can see that we kind of broke the uptrend line, wobbled here for a while, and then in mid 2007 started to fall apart. When we fell apart, that was a pretty important place on the chart. And what we're seeing here as this market starts to unload over on the other side, this is the same sort of trend. Now people will say, oh, it's just like 2016, we're going to come down here and rally. I think the big change here is the global situation. So we're having central banks drop their interest rates worldwide, and the Fed is trying to keep up with some of the pressure, but the issue that we have is just this global momentum is stalled, and so as all of this happens, people are heading into yields, so they're putting money in, and it's forcing the bond yields lower and lower and lower, and then worldwide we've got a lot of growth issues. I think we all heard about Germany this morning, but we're seeing these big moves down in these foreign markets in terms of growth, and I continue to think that's going to be the problem. So as global growth slows, S&P 500 sells half of their stuff globally. If they have to do that in a slowing environment, that's probably going to impact earnings and eventually slow the US stock market. Well, these charts are all telling me the big things that were going on have broken and are accelerating lower. Here's the 2-year, just a big picture, and you can see, for a long time it was gently jogging lower and no big deal. So, can the stock market go higher while the bond market goes lower? Absolutely. The real problem that we have is, of course, the global momentum that we were trying to get going. Just, as soon as we've stopped quantitative easing, basically global momentum has slowed, and now they're going to start trying to figure out how to get it going again. This is the 2-year Treasury, and what you see is obviously zoomed in on that other chart that I showed, comparing back to 2007. And one of the concerns I have on this chart, maybe it's on my next one, let's just go there and check. Yeah, this one. So I published this quite a while ago, but as this RSI indicator started to top out, so this is a relative strength of the price movement of the chart itself. And what we see here on this monthly chart was that back in 2000, when this chart topped out and started to fall below 50, it was a pretty good clue that the stock market was going to have trouble. Then in 2006, it stayed above the 50 level until mid 2007, and I think we all remember what happened there. And then here we are sitting roughly May, June, maybe even April, and it started to fall below this 50 level on this chart again. And now it looks to me like it's breaking down. Now, again, the stock market topped, if it was going to top with the top of the bump or just the break of the RSI, would have been these red arrows. But here you can see clearly a lag effect here, and then all of a sudden it dropped about a year later. In 2000, I think it topped closer, in the spring timeframe, but it was the October high that actually marked the top of the market. So the NASDAQ topped in March, but the S&P topped, I think, September 21st, if my dates are right, back in 2000. So it went back and tested the prior high and then failed right then. So it was that secondary test to the prior high, whether it actually made a new high or not. It was right up at the prior high and broke down from there. So this is the 3-month Treasury yields, and I think this is pretty ugly. I got one more chart that I want to share with you about the 3-year or the 3-month. And when I come back from this quick commercial break, I'm going to bring you that chart, and I'll let you interpret what you want to see on it. But we'll take a break right now, and I'll be right back. back, and for those that have read my blogs over the years, um, it was a really interesting time through 2009 to 2016. You just saw this chart absolutely um, ripped apart, and you could see the violent moves. I mean, as a percentage, these moves were huge, but for most investors, obviously, it was just comparing 0 to zero point 0.1 and not really that indicative. But here's what we see over here in 2000 when this 3 month started to break through its 200-day moving average. This was a pretty good clue. And until we really got things improved on the bottom side, early 2004, this thing took off. Got up to 2007, started to break down. Now you can see it stayed up here for almost all year, and then it started to fall away. So, excluding this beautiful part in here, that's the hard part to live through. You can see my notes here on the PPO: calm before the storm, calm before the storm, calm before the storm. And I think the storm is starting to set in here. But what we see is this 200-day moving average now violated. We've spent months below it, and the market seems to be breaking down. Now, there's one more chart that scares me more, and this is the chart with recessions marked on it. And clearly what you see is when these things rolled over pretty hard, these were recessionary times. Now it all looks easy to go back and look in hindsight. This would have been, somewhat scary, and then it turned in reverse. So let's not just say it rolled over, so it's done. We went all the way through the 95, 96, 97 period with this downtrended, and the market obviously continued higher. So I would just say that on a global growth scale, we've been quiet for 10 years here, just looking at the spacing between the bars. 1991 to 2001 was a pretty wide period. We've now gone another 10 years here, even 12 years from the top. So looking at this chart, it just says, we might be overdue for recession. And again, a recession is only 2 quarters of negative growth. So keep that into context. Out of the last 50 years, we've had very few quarters of negative growth year on year. I will say that it's the global picture that bothers me more than the American picture. Obviously, the retail and everything in America is still going fine, but the rest of the world is definitely not moving as quick. Okay, don't need to get into that chart today. That'll get me distracted onto another whole subject. So let's keep going back to the table I wanted to stay on. This chart looks a little busy, but what I wanted to show here is we see these big moves down here on the MACD, and you could do the same on the PPO up at the top, but you get these big dips down, and then all of a sudden we started to make a second positive divergent wave, finally got back above this 2% level, and it's moved up. Now, this 3% looks magical, but when you go up to the PPO, what you'll see is 2% is just halfway there, and there's lots of these peaks that make it over 4% as a percentage. So our swing back could be radical and all the way back up to the other side of this channel. Now, it doesn't have to move straight back there. It could have a 1-year jog in the middle here. That kind of thing. But typically when you see these big oversold conditions, they can move all the way back to the other side of the channel. And then, as we get up there, that would be pretty big. And I think for those that have been following me over the years, I think we called this top pretty well. And that move down was significant. And now we broke that trend line. We started to move up. So this MACD for most people would look pretty extended, but remember that on the MACD, what happens is these waves get bigger as it goes farther up the scale. Whereas on the PPO, the percentage, this wave, I'll say here, is the same as this wave over here in terms of percentage move. And that's because we're using a price percentage, and down here we're using the actual value of the scale over here to measure the difference in the stock rate of change. So while the MACD looks extended, the PPO just looks middle of the range. And that's the point I want to make here, is we have lots of room to run on this chart. Okay, this is the USB, the 30-year bond, and what you see, obviously we're clearly moving up. We had a big bear market going on here until early 2019. We broke above it, and as long as we stay above the 40 level, we're going to be in a big bull market. Well, that could last 2 or 3 years, and you'll also notice that the stock market was up in late 2014. It actually topped in early 2015, and then I think everybody remembers the 2016 low on the stock market. the bond market's timing won't be the same. But I think the big thing that we want to be aware of is when the bond market changes tune. And just this is a long period full stochastic. Let's call it an 80,3. So 80 weeks, roughly 6 quarters. And what you see here is it stayed above for a year and a half, then it fell below for a year, then it stayed above for 2 years, then fell below for 2.5. These are long cycles. This thing could run for a while. That doesn't mean it doesn't do this in the middle, but we have lots of opportunity for this to continue. So just when everybody starts to think, okay, we must be near the lows, it would be shocking to be at the lows within a week of the Fed doing its first interest rate drop. So you see this 2016 low being tested. Now, if we just open up the tape here, here's your 2011, 2012 area. And again, we're on the 30-year here, not the 10-year. But we're down here at the extremes, and if we start to go below this level, let's turn on the price labels there. So this little box here, if you check it, see how there's no price label here telling us what that actual final reading was. When we update this chart, we get these little price labels. So 21.02 or 2.1% for the 30-year, and it looks to me, let's just check the low so far. Yeah, we got within a heartbeat of that. We got 0.2 0.2% away from actually busting through the low today. Now, this is a weekly chart. We got lots of time left, so I'm expecting that low to get taken out. And let's just go back 1 second. And one of the reasons, see what happened on the PPO here. We broke this long-term trend line, started to break lower in May, June, July. This thing just kept going. And so now that we've, I'll call it established a downtrend, again, doesn't mean we won't revert back and spend a couple of months backing and filling. But clearly we've broken any sort of uptrend we had for 4 years. And I think the same thing's happening in the stock market, as I mentioned last week. Okay, TLT clearly to the moon and rising. So if that doesn't look like a blow off, it looks like a blow off to me. But I think, again, it just needs time to kind of consolidate its gains, and then you might see another move. Now, here's the 30-year annual closing levels on each one of these. So we're well above the annual closing high if the market was to close here. We're only in August, so we got some time. But the point I want to make is that this thing is moving up and away. And really clearly, if things don't improve in the latter half of the year, it would have to get all the way back to 1.5, 150 to get this chart back in here. So I think just being aware of where we are in the trend, we're clearly blowing out the top side here, but we could go all the way back to the top of this channel, nothing preventing us from that. Okay, and this is the chart. I think you guys will remember this one just because it's so colorful. The one thing on this chart, this shows the yield stack or the yield curve. So 1 year, 2 year, 3 year, 5 year, 10 year, 30-year. And what happens in normal markets, this is the normal spacing. What we've got going on over here, so this is the 30-year, this is the 10-year, 5-year, 1 year, and then you've got your 2 year is above your 5 year, and these are all mixed up, right? So this order over here is not the same as here. What we would be expecting is when this yield curve actually starts to normalize and spread back out, that's another place to look for really fast market moves when the 1 year is dropping so fast that it actually gets back below all of these other yields. So that would just be picking up the pace. This is one chart I've been watching, and again, back in 2007, 2008, this thing went ballistic long before Bear Stearns broke out. And so this big move, the spread between the 30-year and the 10-year, it was a pretty important place on the chart. And we've just started that move now today. And again, on any given day, this thing is going to whip wildly. The scale is really small. But again, the general trend you can see is up and away. And I would expect that to kind of keep going, whether or not it backs and fills here and keeps going. This is a significant move that's broken a trend. We've got 5 other trend breaks on here, and most were associated with recessions. This is the 5-year comparison, and you can see we broke out here, but we've just kind of wobbled our way sideways. Still watching closely to see which way this goes. This is still above the 200-day moving average and has been since the October trend change. So, until this starts to return to normal, get back to the underside of the 200, that's probably just a clue for us to be more cautious. Okay, so obviously that was a big deal. I think the bonds, hopefully I put that into perspective of how much the trend changes. I mentioned Disney and the Beast, and I think the Beast is their new online streaming service. And this stock pulled down hard this morning and has rallied up a little bit. But really, the news that we need to be aware of, I think the overall stock markets are going to pull back here for 4 to 6 weeks, and then we'll start to worry about whether or not we can get a rally. But it looks to me like most things are pulling in a little bit, and as these trade fears and PMI calculations keep showing slower growth worldwide, central banks worldwide trying to cut to get things going, U.S. Bank just starting to do that. All of these things add up to me to be a slower place. And in case you didn't hear my discussion last week on Market Buzz, where I mentioned that the S&P topped out on October the 9th, 2007. The Fed had actually done its first interest rate just 3 weeks before that, September the 17th. And then by October, the Fed did one more, the end of October, and people were like, okay, that's the last one because inflation is still rearing its head. Well, by December, the Fed did another one, and by January, it actually did an intermediate cut, and then at the end of January, it did another cut. So, nobody saw anything coming. October, everything was fine, and then by January, it was like, oh my goodness, everything is breaking down. So my perspective is here, don't get swooned by the media. I heard one gentleman today say everything is fine. He's in the financial markets. And I'm like, how can you have the bond market falling apart and say everything is fine? I see no risk on the horizon. Like, you just want to literally ask him what he's thinking. But there's lots of risk out there. Anyway, I think Disney's, this chart had a massive breakout. It's going to pull back. Let's say it gives you a gift to come in all the way back to this 118, 120 breakout level. Maybe sitting down there, start to see some improvement in trend. That looks like a great place to pick up Disney. So I don't think you need to rush into it here to buy it. But if you get some sort of an opportunity on a pullback, that's where you want to pick up Disney. I think there's going to be a great opportunity for 2020 in a company like that. Okay, oil. Let me get over to my actually, before I do that, I'm going to go into the Russell here. And the one thing, let's just update this for the current mayhem that we have going on. And we're trying to bounce out of the hole again this morning, so that would be good. But you can see the Russell's testing this key level. When we look at, if I do WTIC, the one thing I want to just share here is that we're trying to test this low now, down about $50, but you can see that the uptrend here has been broken. And so as oil feeds lower, I think that's a bigger deal. And I think today it's probably at $52 or something. So we're testing this horizontal, but I think it's a bigger deal. Thanks for taking the time to join me on Market Buzz. Market Buzz airs live on Wednesdays and Fridays at 10:30 a.m. Eastern and 7:30 Pacific time on StockCharts TV. Thanks, and keep reading my blogs. Appreciate it. Bye-bye.